Hey guys, welcome back to Seller Sessions. Last day pretty much of Q4. I've got esteemed guests here, of course, Steve Simonson, Liran, Hirschkorn, and Brandon Young. How you doing, fellas?
Good.
Well, thank you.
Danny.
Excellent. So before we get in to do like a roundup and a wrap of the year, Steve, congratulations. I hear retirement is in play. Is that right? Have you retired?
Yeah, retirement 2.0, Danny. We're doing it bigger and better than last time when it sucked.
Yeah.
I'm working the bugs out. So I'm cutting my time from 70 hours a week to 35 and only doing stuff I like. So, it's going to be fun.
Excellent. So by March, we'll be back to normal again and be 3.0 discussion.
That is the number one prediction.
Yeah. Liran, how's things with you? How's your year been?
I'm retiring too. No, I'm just kidding. I've been great. Been doing well, and it's nice. It's a little bit less busy now. You know, the last this kind of week and next week. So I'm looking forward to a little bit of downtime, and then 2023.
Excellent, Brandon.
Yeah, I wish it was getting less busy for me. I've got an event in 2 weeks that's just got me working extra and overtime. But most people are enjoying their decompressing and enjoying their vacation for the next couple of weeks, and I'm going to be running around working crazy hours.
Indeed.
As you know, with Seller Sessions Live, the 2 weeks leading up to it you don't sleep much.
Yeah, I think I have to kind of record my cortisol by day for Seller Sessions Live. Do you know what I mean? It does definitely peak leading up. You're literally, like you said, we were talking off call about negotiation with hotels, and I've had a venue change. I found out we lost the venue without knowing, only because we went to change the date. So I've been nitpicking with half a dozen venues for the last 2 weeks. And you just mentioned that you got CPTSD because you got an event in 2 weeks' time. So I'm feeling your pain now. All right, so let's kick off the show. Obviously, I want you guys to cover we're going to do like a history of this year, but a rerun of this year. Let's kick off with January to March aggregators. We did see a massive change, right? So we see deals getting closed up till Christmas, slow down after January, deals were being dropped to a certain degree. And then around March, we start to see the layoffs and stuff. So we see a big impact of those guys coming in, which has been great for the industry. It's made people good money to set their futures up and stuff. So that's been really good. But there was a massive drop, and then we can talk about recovery coming. So Steve, what did you have the same prediction? You see what you could call a mini bubble inside the Amazon community for aggregators. But how did you see that playing out anyway?
Well, the reality is every consolidation of an industry works the same exact way.
Yeah.
You get one or two people who say, "Hey, I've got an idea," and then you get about 200 dozen followers who go, "Hey, I also have an idea," and it's remarkably similar to this other idea without vetting the idea or without understanding the complexity of the idea.
Yeah.
And so it was always, I've said for years, it was always going to be 75 to 80% of those people ultimately failing.
Yeah.
In other words, not being around. Now, some of them will get absorbed and they can call that a win. Well, we sold out to a bigger fish, but really, if you didn't achieve your goal, you're dead. And I'm not judging. That's just the way it is in the world.
Yeah.
My guess is that was the first iteration of those layoffs. You will expect to see that coming up in this next quarter as well.
Yeah.
Operational performance of any business, especially founder-driven businesses, is really hard to consolidate. Everyone underestimates how much it takes to keep a business like this afloat, and founders will do anything and everything. And corporate folks, if you have the MBA and you have all this stuff, you're like, hey, it's 5 o'clock. It's time to go home. And if this doesn't work, I'll get another job somewhere else. And we're in it because we need to eat.
Yeah, indeed. And everything looks great modeled out in a spreadsheet, right?
Correct.
Liran, what's been your take on it? You've been close to the action. We'll get to Brandon on his thoughts on it as well. What's your thoughts on it?
Yeah. This kind of reminds me of something we saw in the .com bust. And during that time, Steve, I'm sure will remember, Brendan probably too. We had Alan Greenspan, and he used these famous words. We had irrational exuberance, right? I'm sure, Steve, you remember this.
For sure.
And basically, there was a emotional, irrational buying of brands that should have never been sold. Never been sold, never been bought. Now, I'm happy for those sellers. For one time, the little guy, people who sold in 21,
They won.
I mean, yeah, they'll never be able to sell those brands today. And I'm, really happy for those sellers. They got 6x, multiple on their brands. At the same time, those brands should have never been sold in the first place. What I've seen is that it seems to me that, first to market's not always best, right? Because people can see the mistakes. Thrasio was first to market. They pretty much bought everything. They were, I would say, boasting about buying, 2 to 3 brands a week, but it's not sustainable to actually manage them. I also think you had a major problem that the whole idea of aggregating was, we're going to buy these brands and then we're going to have efficiency improvements. But I think what's very challenging in this case is that you have to go back to the supply chain and try to think that you can now, consolidate multiple factories like into one factory and get improvements based on that. And it's very, very challenging to like reverse the supply chain process, which I think was part of the thesis here. And instead of being more efficient, average aggregator had like 10 employees per brand. Average entrepreneur that sold was like one guy with like 2 VAs, right? And instead of aggregators being smart and keeping people on and hiring overseas, they hired everybody in the US at 6-figure plus salaries. So a lot of mistakes were made, right? Some of what I've seen is that there are some aggregators that came in after the initial that said, hey, we're going to buy more like brands, some that are in retail and on Amazon, multi-channel, right? I think that has a lot more viability. But the theory that if the whole theory was like arbitrage, right? I have one brand at 3x, but 10 brands equals 20x, right? But does it really? So I think the model is not that great, and like Steve said, the entrepreneurs are a lot scrappier than employee John, that's never been on Amazon before, out of college or MBA, and really smart, but doesn't have that experience. And with Amazon, you need a lot of grit.
Yeah. Brandon, what's your take?
I agree with a lot of what Liran's saying, and I disagree with some of it. So I do agree that replacing the thesis of being able to replace an entrepreneur. Is that echo from me? I'm sorry.
I might be Liran. I'll just mute your mic. Is that okay? Just
sorry about that. Yeah. So I would agree that like the replacing an entrepreneur that's working 78 hours a week, that cares about their business, and like what Steve said, because we want to eat, we want to grow, we're hungry for it, with 9 to 5 guys who aren't going to have visibility on that product overnight when things can go wrong or when you need to make adjustments. There's more efficient ways to do it, but you have to understand that the climate during 2020, 2021 was right to buy cash flowing assets. Money was about as free as it could possibly get. Yeah. And when money is free, you should go and buy assets that are going to cash flow, right? Like that is just what you should do to build wealth. So that thesis was right. The other part of it was, what is the value add that you're going to do once you buy the brand? And what are you going to do to grow it? And it wasn't just about like maybe making the supply chain more efficient and getting some small wins from efficiencies or economies of scale. It was going to be from bringing that brand to other marketplaces, bringing them off of Amazon. The challenge, though, I think, is that they didn't think through the difference in setting up an entire different supply chain and business model for a different channel. If you're sending products to a warehouse and the warehouse has to then fulfill individual orders for D2C, that's a really different business than just sending in pallets of goods or containers of goods into Amazon and then having Amazon do all the work for you. And then that is far, far less efficient of a supply chain. And that was one of the reasons that we've grown our Amazon business strictly on Amazon, because we did experiment with some wholesale and some other things. But at the end of the day, the juice wasn't worth the squeeze. Like for the same amount of effort, I could launch 5 more products on Amazon and have a significant impact on my top and bottom line. And so now where I think they'll start to win, though, is where Walmart, and we can get into like the future, but like when we get there, because I know you're going one step at a time, but now that Walmart has a fulfillment center, I think that that's a huge opportunity. But many of them have figured it out, for good or for bad. Some are going to get absorbed, some are going to fail, but there were guys that kind of have come in and are pulling out of it. They've started to streamline. But you have a bunch of smart bankers that came in with this idea that they copied from someone else, and they didn't realize how hard Amazon really is. And now they're starting to bring on the right experts. They're starting to really get really good at it, and I think they're going to be better at it than most sellers if they already aren't.
Yeah, I totally agree on that, because they go through that whole learning process. What is quite telling as well, Razor's just raise money, right? But it's equity, not debt, and there's a telling sign there. So can we call that a down round? Meaning is that the leverage has disappeared there because money isn't cheap anymore. And in order to get that money, they'd have to give up some equity. We don't know how much, but that's a telling sign. But what about the guys that hunkered down? You know, the kind of, it's got a lot quiet. You know, you're not seeing them as much in the space, advertising as much and stuff like that. What can we see in a return? Because we are seeing an upswing now, right? We're seeing more acquisitions start to creep up. We see the big drop in March. So I know that you can't just make shit happen as fast as that in 6 to 8 months. But I definitely think there's a lot of steam ahead within that market with a truncated amount of aggregators that are good operators.
I think
I'll throw that to you,
Danny. I think a couple things. Yeah. One, I think this is a great business lesson for a lot of people watching. For us, here, like who watch from the sidelines, is that don't make business decisions out of FOMO. And you saw a lot of this, right? Like you saw, few aggregators that sort of started early, and then everybody just chased this thing, right? And it's kind of like, if you're at that stage, you're probably too late for the most part, right? Like part of the reason also Thrashio had more early success is they were initially buying at 2 and 2.5 times profits, right? EBITDA. And then all these other guys came in and everything got pushed up because of all the demand and FOMO. And again, I think it's a good, it's kind of like the stories you hear from sellers, you see already 20 successful people selling this product and you jump on, right? You're likely not going to be that successful like the first guys who got in on the opportunity of a trending, sort of product. So I think it's an important business lesson. As far as buying activity, I think what's happened is I think initially when multiples, when aggregators kind of pulled back and multiples went down, sellers said, heck, I'm not selling at this multiple, right? And so I think now there's probably people getting used to the sort of new multiples who may decide to sell as a result, because now it's kind of been some time since these multiples have gone down. A couple of interesting things is recently I was contacted by a new aggregator that made their first acquisition, which is kind of interesting, like new players getting into the market. Again, I think partly because you kind of seen the crash, and now again multiples are less, and they think maybe there's an opportunity, and what learnings they can have from everything they've seen. And two, the second thing is that I think we just saw Berlin Group just raise $70 million in equity, which is kind of interesting. Apparently,
I think it was Razor.
Razor.
That's what I mentioned earlier. The Razor Group raised equity instead of debt. Yeah,
they raised equity, and apparently at the same like $1 billion valuation or so, which is kind of interesting. I know they had a lot of layoffs this year, but that's kind of interesting that they were able to do that, right? But we see numbers a lot smaller than the hundreds of millions that you saw last year.
What's your take, Steve, on the Razor thing there and the switch? We're seeing now more equity rather than debt raising
Well,
money.
obviously, with the interest rate changes, it's just simply not affordable to keep running. Brandon's quite right. It was free money, and now it costs money. And when you look at those alternatives from a pure operational standpoint, you can't do it the same way.
Yeah.
There's no question in my mind that as you see, whether it's equity raised or even if they continue to use some of their existing debt facilities, you're going to see winners and losers, right? And it doesn't really matter on the tactical level. The market is going to do what the market does. Sometimes prices will be where they are now. Sometimes they'll be higher. And these cycles will continue. Believe it or not, everybody, thinks we saw the high and now thinks that we see the low. And it's like, well, that's the new normal and that's just the way it is. But no. In 2 or 3 years, it'll be a high again because everybody got drunk and forgot what happened. And now somebody got new money and some other method of bringing it. So these cycles change. And the lesson for me is like, if you don't understand your future competition, you got China to deal with and you got giant corporate aggregators to deal with. Those are dominant players in every category on Amazon. That's the future. Yeah. Then you're just not prepared. And so I would pay close attention to that reality. There will be winners, and they are getting really good at operations, and they have more staying power than the average seller. Yeah. And that's just the future.
Steve, I have a couple questions for you. One, you say we're going to see the winners and losers, right? Haven't we already seen a lot of losers in the sense that, you have companies that have raised more money than their valuation?
Well, for sure, but that's not the end of the story unless they wrap it up. Now, I've personally witnessed, and we've had the chance to, pick through the bones if we wanted, a number of, let's say, small scale aggregators, less than 50 million raised, rolling up or rolling out, right? They're just kind of disappearing. But that's not as public as some of the things that will be coming, right? It will be a bloodbath in 2023, but some of that will
be careful with that quote, Steve. I got nailed in the magazine for that, didn't I? Only a few months ago. But
is that right?
Steve, you're right in the sense that, like, I have a client that's a small aggregator. They have maybe like 9 brands. They're doing very well. They're operators, right? So I think that also there's these stories that exist out there, but you don't hear a lot of them because these are not the big names that have raised, $100 million plus.
There's plenty of, by the way, operators like you guys who have run businesses for all these years that are rolling up and adding additional operational entities or brands, and those will do very well or have the capacity to do very well because, and again, I'm not even trashing aggregators. I want to be very clear about that.
No, I'm in support of them because of what they've brought into the game. Do you see what I mean? Now you can exit. You could always exit. But it's now become a trend, right? So there's a pathway out because we know this is an asset business.
They made it a lot easier to legitimize an exit on a 2-year-old business, which is crazy. That said, only the best deals are going to get done. Only businesses of real value will achieve high, ratios of earnings and so forth, seller discretionary earnings. But my basic level set for everybody is a good business gets paid, right? A solid operation gets, always the best valuations, and the best operators, whether they're large or small, will always have a future. And that means we need to have fundamentals and we need to be disciplined. That's it.
Let me ask a little bit of a controversial question here. Are we seeing the same thing happening in the software aggregation space at the moment? I'm not just talking, let's say, Carbon 6. There's several companies, right, that are acquiring multiple software roll-ups. Is there a lesson that's not being learned necessarily from, buying up too many software companies too fast? Is it how similar or different?
Well, there's not, for a start, there's not 100 of them like there was with. Do you
there
see
are-
what I mean? So it is a smaller market to soak up, I suppose, isn't it?
To me, it's all about the fundamental economics. I'll let Brandon jump in here, but the
Yeah, we
truth
haven't heard
is,
from Brandon for a bit.
yeah, you can make any of these things work, but it's just pure economics and then execution. So I'm not for or against any specific model. I'm just saying, like, it doesn't matter to me how many companies you buy. I bought a bunch of them. You can, and by the way, I've failed at some of the ones I bought. I bought one for $6 million. We sucked at it. That was not a great investment for us, but well, what are you going to do? So Brandon, what do you say?
I mean, I'll go back to, like, I'm not as bearish on the aggregators as everyone else. I think that what they're doing is fine. I think that there were a lot of macro factors that impacted the success of a lot of them as well. Not just rising interest rates and impacting their debt facilities, but also the demand in e-commerce dropping after COVID. Just the economy coming down. A lot of them did make mistakes and buy with a history of sales that fell, right? So like effectively increasing the multiple that they purchased at. So there were a lot of things. I think from a tactical perspective, we talked about how they can improve there as well. And I think they are. They're starting to. I've seen very successful brands that keep on the operators that with incentives, but have them run for a period of time so that they can train and really understand the systems. Liran, you were just mentioned the other day that you had a client who sold to an aggregator and they insisted on keeping you on to continue to run the PPC.
Right.
Because I've seen the horror stories, like a lawsuit happening right now where someone buys a company and immediately tries to maximize profits by slowing down ad spend, and then it spirals down and you end up killing the market share and the product and the profit and the top line and bottom line, right? Short-term gain for long-term death. Like, it doesn't make any sense. So I think that those mistakes are being made less and less. And now that the market is kind of settled, I can't say it's settled. I think we're going into a recession next year, right? Things are going to change again. If you bought luxury and travel goods brand last month, you're probably going to see a down year next year, right? So as Steve said, there is no new normal. Everything is always changing. The only thing that we can be aware of is that things are going to change. And so you just have to try to guess where we are in that cycle and try to make the best decisions for that. I think that now is not even an option.
Can we sorry, because I'm thinking of time. I'd love to get through a few more subjects. Could we round off on this bit and then let's go into a bright light? Shipping has improved from our last year.
You mentioned software. Do you want me to mention something? Because data dive and everything, it's really, really hard to buy software for the purpose of incorporating it, right? Like, I've been through the due diligence process a couple times with trying to acquire other software companies to accelerate. And usually you buy software for three reasons. You buy to acquire the talent, the team, so an acqui-hire. You want to get new customers, so it's like an acquisition of customer base, and an ARR, MRR, so revenue, right? And then the other would be for the technology to accelerate, like a buy versus build. So those are the three reasons that you buy. But a lot of times it's really hard because things are written in different languages. Code. It's not a plug and play. There's overlap of technology. Maybe it's not in the same exact strategy that you were planning on building anyway. So you have to rebuild it. And then sometimes the team doesn't exist. It's like one guy that built something, right? And like, you're not getting a talented team. Or it's too expensive to hire that guy because he was the founder and now he wants like $250,000 a year. You could, you need different people anyway. So I think the thesis of patching a bunch of things together, like a couple of the guys out there are doing, is going to be much, much harder than people realize, because you have to build centralized technology that talks to each other. You have to have a central hub with APIs, build in APIs to everything else, redo a lot of the technology, and then you can start to get them to talk to each other to make that efficiency a thing. The immediate impact is, or like for next year or so, the only gain you're going to get is giving people discounts on bundling, right? but are you making money at that? Like, what does it cost to run these softwares? So will they win? Maybe in a year to 2 years, we'll see some really big movement, but it's going to be a while before we start to see this massive play like you would see from some of these multi-unicorn type software companies, like a NetSuite or something. Steve knows more about that than I do because he has like a NetSuite for type software. Like I'm on the bottom moving up, and he's at the top already, so he'll tell you more.
Moving down.
Steve, starting with you, shipping, and then we'll move to Brandon, because you've seen quite a shift there from last year. Do you want to elaborate on what trends you've seen and where we are today with it?
Yeah, so today we're accessing rates below the pre-pandemic, as predicted. Even during the height, when people are spending $20,000+ for a container, we said at the time, not all the freight guys, but many of the freight guys would be like, you're never going down in price again. This is the new normal, right? This is just the way I'm like, nope, it's a market. If supply is lower than demand, price go up. And when it's the other way, price go down. And that's what's happening. And you will see extraordinary pressure as there are new container ships coming online, because the bullwhip effect, if anybody hasn't checked that out, they can go Google it. But the bullwhip effect of shipping will continue to play out, which means, more ships, more supply, more containers. They're in for, a rough go. If you're in a freight forwarding, capacity, it's going to be difficult, but that's good. And that will help margin, and it will, there's a lot of positives for general economics. It's not great for the freight forwarders, but they'll be okay. Don't worry, Danny.
We'll get on to margin suppression next as well, and cover this first. Brandon, your take. What have you been seeing? What do you see coming up now over the next 6 to 8 months?
Oh, I'm super excited about shipping being as cheap as it is. I think it's an amazing time. So this doom and gloom thing, I made a video about this the other day. I think the doom and gloom is like when everyone's fearful is when you should probably be buying, right? Like that's the big sentiment from some of the smartest investors in the history of investing. And so that's the way I'm looking at e-commerce. I'm doubling down. I'm looking for other opportunities because supply chain is going to be at an all-time low. Factories are looking for opportunities to make stuff that they're not normally making. If you're really solid at the organic ranking and can find the traffic for your products when everyone else is kind of struggling, you're going to be able to go wider faster at this time. So while everyone's kind of retracting, I'm looking to spend more.
Yeah. Cool. Liran, margin suppression. We'll move quickly because we covered the aggregators for out of 27 minutes. They got 25. So let's get some more stuff on a speedy level. Let's start with you, Liran, margin suppression.
Yeah.
You've seen this at the agency as well with all your clients, right?
Yeah. So I would say this Q4 was, I would say, successful for sellers, but generally tacos was higher than it was last year, for example. Yeah. Right. So while people generally had more sales, and I think Black Friday, Cyber Monday this year was bigger than it was last year for our clients. Again, generally seeing higher tacos. So yeah, margin suppression, definitely a thing. And as we're talking to clients, they're trying to find ways they can sort of cut some things or improve efficiency in order to improve their margins. So we've definitely seen, margin compression. At the same time, I would say we so far have not seen a big impact as a result of the economy. I would say for our clients, they did well this Q4. Although Black Friday, Cyber Monday was a lot more successful than it seemed to just be kind of okay after that, because probably a lot of people bought. There were a lot more deals. So it'll be interesting to see what happens next year. But I think everybody is thinking about how they can further optimize their business as we get into 2023 with sort of some unknowns as far as what the economy is gonna be like. I'd love to hear Steve's take on what he
and also it's nice that you're not paying 25 grand for a container anymore. That's going to help a little bit with margin suppression as well. Steve, what was the term we did the show? I can't remember the terminology in terms of controlling the costs up front instead of post. What was the terminology that you used in the show? You know, we've done the show in terms of economics, breaking it down, and we're using the cost center down on the SKU level. I forgot what you called it, but there's actually terminology for it.
Well, I don't remember precisely what you're referring to, whether it's landed cost or basic unit economics or what
Basic
have you.
unit economics. That's it.
Yeah,
That's
what we always go back to, basic
Yeah.
unit economics, because it's like a muscle that you have to exercise. And by the way, this is the perfect time to get really, really fit, right? Because everything you do in your business, it requires good execution, requires good thought. And all of those muscles will serve you well when times get easy again. So lean times are the perfect time to really know if you're a good operator or just living in the slop like that. That's kind of what happens when the tide's rising. Yeah. So I'm not afraid of these recession type scenarios. I've seen them before. There's great opportunity in them. Like Brandon, we seek out ways, typically in a product business, but it happens to service businesses too. You seek out ways to take market share during those times when everybody else is pulling back or afraid. But that doesn't mean you can't lose track of those fundamentals. Getting a better price, tracking the currency, all of those basic unit economic factors should be definitely dealt with. And I'll tell you, many of the Chinese factories in the last quarter, they're down 30 to 50% or higher, year over year. There is no fix for that, right? It just has to play out. And some of it is because too much inventory and it's at the higher cost from the old day. There's many variables at play here, but I would just say that, get good and get lean on every single line item on your P&L. And if you don't understand it, then you better get good at it, because somebody else somewhere is practicing and they'll beat you.
Yeah. Brandon, some of the things that you've dealt with this year in terms of margin suppression and your workarounds.
For us, it was, we just accepted early on that we were going to have low margins, but we kind of like drove head first into them in order to maintain market share. Mm-hmm. And understanding that it was going to, the tides were going to change. So it did a couple different things for us. Like I showed a screenshot earlier in the year where I was like, we had single digit margins the last few months. Right. And people were surprised. They're like, oh, you did $1 million top line, for this month. And I was like, yeah, we made single digit margins, net margin. But that's okay. We launched like 50 new products. We're pumping, right? Like we're growing, we're spending money to grow organic ranks and to grow keyword ranks. And come Q4, we're going to cash in. And our numbers in Q4, our tacos were sub 10%. Our margins were 28 or more %. And we did, 5.8 million the last 30 days. So we crushed Q4 because we were okay maintaining market share, growing market share, and then steering away competitors or just making sure competitors couldn't come into the market. So it's a different mindset than a lot of people have, which is, oh, I'm not making any money. This business isn't right. This isn't a good business, right? It's just, you have to have a long-term look or outlook when you're in this business.
Indeed. We'll move on to PPC in a moment. Liran, I'd like to get more feedback from you as you run a large agency. Ellis sent me over some notes because I was asking him about certain things, some of the trends he's seen at the agency. So he said 2022 was probably the toughest year on average for our clients in terms of profit margins. Q4 went better than expected in several ways, contrasted from last year. Sales the week before Black Friday were much stronger. FBA deliveries were shorter, so sales remained higher closer to Christmas. Average Q4 tacos did not go higher this year, in contrast to the trend of creeping out higher each and every year. Q4 had the following new challenges for us here as well. In some niches, cost per clicks with gift keywords grew too high to advertise on profitably, if at all. One of our clients, what does it say here? In one of our clients, you didn't get impressions for less than $20 a click, and suggested bids were $49. Also, we've got an Amazon push.
Is that in pet supplements?
I can't discuss that. I'd have to shoot you otherwise.
Really?
In Amazon's push to extract
AJ Patel.
In Amazon's push to extract even more profits from merchants, they've made we know about this. Keyword matches less precise, which reduces advertising control, decreases conversion rates, and increases ACOS across ACOS and spend. Advertising example here on Christian gifts can match searches of supportive gifts. So overall, we've seen a pretty rough time for sellers on the PPC side. We've seen Amazon increase their greed in terms of advertising slots across the year. We can break that down into detail. But generally, it's been quite tough, I think, on that end of the spectrum. And there needs to be a rethink. You know, some people are being pushed out the market to operate to do PPC. Let's be real, right? And at the end of the day, as our job as an agency as well, is to serve the customer. And ultimately, it's finding new ways. You can't break mathematics. So effectively, if you're in a hyper competitive niche and you've got a margin of $1 to play with, and it's $5 a click and you convert every 10 clicks, you don't need to be fucking Sherlock Holmes to let you know that ain't going to work for anyone, right? Don't matter if you've got Dr. Ellis Whitehead, he ain't going to fix mathematics. But it's going to be a trying time. What are you seeing with the agency? I've seen you spread out a bit, Liran. You're doing other stuff as well with the PPC in terms of external traffic and stuff. But are you seeing that connecting properly?
So actually we spent some time this year really testing on influencer marketing, and we actually stopped doing it. The reason we stopped doing it is because of a few factors. One, it's very, very, very challenging to track the impact of sales from outside traffic into Amazon. Amazon attribution is broken. People don't click links when they see an organic TikTok. They go to Amazon and search the brand, and it's and then with changes happening on Amazon, people changing price, running deals, whatever, trying to attribute the fact that you just ran something and the increase in sales. I would say we've also done a lot less Google to Amazon. We saw maybe a year and a half ago big increases in rank. I'm 100% sure that Amazon changed the algorithm, because we're not seeing the same kind of things, very mixed results in terms of Google traffic into Amazon. So we've sort of refocused on advertising, listing optimization, do seller operations, but really refocusing on, you know, more on the PPC side. Seeing a lot of the same things you mentioned. But I do think, kind of like Steve said, that there will be an opportunity, because it's getting more challenging for smaller sellers. It's getting more challenging for people that are either not outsourcing or don't have the expertise in-house. PPC has gotten more and more complex over the last 2 years, and it increasingly gets more and more complex. Even managing the software tools has a lot of a learning curve to it. And so that's going to be the advantage of both the seller who can execute and the agency who can execute, right? So what I told my team is, we don't know what 2023 looks like, but if we execute really well and do really good work, I think that's going to be a big opportunity for us to get market share, because we've already seen some players, agencies out of the market. And I think more people are now, you know, when times are good, they're not, like Steve said, now is like, you have to get fit, right? You have to evaluate every aspect of your business. We're going to be more scrutinized, but also every other agency is going to be more scrutinized. And I encourage sellers to do that, right? Scrutinize every part of your business, and hold agencies accountable, hold whoever's running on your team accountable, and understand what's happening and understand the results of what's happening. So I also think this will be an opportunity for sellers to accelerate, like Brandon is doing. He's launching more products, right? While people might be sitting scared. And I think that's going to be a big opportunity in 2023 for people to get market share, even if an overall market goes down, right? On Amazon, there's so much opportunity to capture, more market share. And we're also adding more tools in order to understand what's happening in the market, in our business, or in our clients' business. For example, we recently started using Cobalt, which is Jungle Scout, like enterprise tool. and it helps us track market share. And so two things I think are going to happen over the next year. One, more people will be looking at things like that, especially if the market's down, right? Well, okay, my sales are down. Is it immediately something's wrong? Maybe I've gained market share, right? You need to look at the market share you're in, and if you've gained or lost market share or maintained, right? We've also seen cases where search volume drops, but people's sales have not dropped as much as the search volume. That's a positive. That's a positive thing. And two, I think with Amazon Marketing Cloud, you'll see people looking at advertising in a different way over the next year, more looking at the customer journey than ROAS, because ROAS gives you only 7-day, 14-day attribution. And Amazon Marketing Cloud is going to allow you to see that, somebody clicked the sponsor brand ad first and then click sponsor product and bought. You don't have the attribution of sponsor brands. They saw a video ad on DSP 3 months ago and they bought today. You're going to have tools that are being worked out right now that are coming out with this, and that are for those that implement this. And again, it's going to be somewhat a little bit of bigger sellers that have the money to pay and utilize these tools. It's going to be to your advantage also, because you'll be able to invest more in sponsor brand ad that really has attribution, multi-touch attribution, but you're not seeing it in the ROAS. And I think that's going to be kind of a shift over year, 2 years in Amazon in terms of advertising, and it'll be a benefit to Amazon ads because people will be willing to spend more in understanding LTV and multi-touch. So these are some of the kind of sea changes I think are happening.
Going back to your point about the complexities have increased as well. Like what we've set goals, and I sat down with our team, what we're doing for next year is to build more tools for efficiency to serve the customers better than we already do. And that's what our engineers tasked and stuff. So normally, like we discuss on here, is like, what, everything's on the downturn. What do? You grow, you go for it. Now, we're not interested in that bit. What we're interested in is how do we improve with the complexities, and what more can we develop to make the team more efficient for a higher level of output without driving them. Because they still need to be relaxed, calm, and be able to think logically and be in a good environment, but also improve it for the customer so they wouldn't want to go anywhere. Because obviously you'll get to the stage with what's been happening with margin compression and stuff. People are going to take in-house, right? And they're going to move from agency to agency in the hope that that agency will be able to provide a better job. And it's a free marketplace, and so they should. Customers should go where they feel is the best suit for them.
And look, I don't think anyone should be, whatever happens with the economy next year, nobody in this space should be blaming the economy on their performance and not growing. Because as a brand, Brandon Young, he's in toys, right? He still has
don't tell anyone.
I won't tell him. He still has a tiny bit of the market share, right, in toys. There's so much more that if he does a better job than his competitors that he can go get. With service companies, software companies in this space. The space is so big and fragmented that everybody, if you go and execute and do the things that everybody is capable of doing, you should be able to grow your business. And I think that's why Steve kind of said, like, I'm not afraid of these times, right? Because he's seen it before, but
numerous times.
What's that?
How many recessions you seen, Steve? 3, 4?
More.
At least 3. I could probably get
yeah.
deeper. But if I go back to the early 90s, I started my first real businesses at scale in recession times. I just didn't know it, and also didn't care. It's like, I got to eat, right? And don't forget, you got to eat. So you'll get good at margin. You'll think strategically about contribution dollars versus margin percentages, and you'll do what it takes. And I love entrepreneurs because we survive on that basis.
Yeah. I'll quickly going to go through and read out some of the comments. I'll bring them up on the screen. And then what I want from you 3 guys, if possible, 2 or 3 other trends you've seen this year that have been interested, and we'll go through and unpack them for the last 15 minutes or so. So up first is Vincenzo. Great stuff, guys. Happy holidays ahead. Yarrow, nice talk. Thank you. Cybe, the e-com space is absolutely no different to any other market that has been or come, and it's basic capitalist economics. Tiffany says, hi guys, hope you're well, Tiff. Side B again, China's flushed itself down the shitter. Factories are desperate for orders. This is the perfect time to be negotiating better prices, terms, MOQs. It then goes on to say if brands and sellers vote with their feet and move to alternative routes to market, won't Amazon respond by making it more attractive to sell and return on the platform? And Side B says, smart as fuck, increase productivity and efficiency without driving them. Love that comment, Danny. Steve, starting with you, other trends that you've seen this year that we haven't brought up on the show?
Well, one that I think is interesting, and it goes to kind of what Side B maybe referred to. I think Amazon Accelerator was an interesting, or Amazon Accelerate was an interesting signal from Amazon. They spent a ton of money. They put on a great show, as I like to say. They Jurassic Parked it. They spared no expense. And part of what I think they're trying to show is we actually are trying to make sellers more partnery than more enemy. Now that we'll see how that comes in real life terms. But I think one of the first indications around that time was what I call the yellow light. We've been arguing for this since 2016 when I started taking groups to Amazon. It's like, it's not just green light, red light. Throw a middle bit in there. Let's call it the yellow light. So the idea that they're like, hey, we got a problem. You got 3 days to help us solve it, but you're not dead yet. We haven't suspended you yet. That is a good sign, and it's something that I hope that Amazon will continue to do. And Bezos coined the phrase, and Dharmesh echoed it, accelerate, which is divinely discontent. They love sellers that are divinely discontent. And I'm like, cool, because I got a bunch of those divinely discontent people. So I actually bought the domain while I was sitting in the audience, divinelydiscontent.org. Yeah. And we'll be doing some campaigns to remind Amazon that, they need to be better and they need to do better. And, I would love to see the competition get stronger, but right now Amazon still has the control of the field. So we do what we got to do.
Yeah. Brandon, sorry, we've been a bit quiet on you on this front. Let's let you lead here. Give us 3 points that you've seen this year in terms of trends that we haven't discussed.
Yeah, I think that off Amazon is representing a better and better opportunity as other marketplaces are starting to catch up. So I think that as I was talking about before with supply chain being significantly different, usually for different marketplaces, the opportunity now exists for you to ship goods into Walmart fulfillment centers. And really it's plug and play, very similar to what you would do with Amazon FBA. So if you can create good listings, and it's been confirmed to me from our Walmart rep, like we sent in some goods and they sold extremely fast. I wish I had ordered a lot more inventory to send into Walmart this year, frankly. But it's been confirmed that if you're using Walmart fulfillment the same way you would be using FBA, that you have better keyword ranks, that they will push your goods. And they're doing a lot to push good sellers and give free deals, the equivalent of deal of the days, the equivalent of these lightning deals and featured deals. And they have a bunch of different things that they're running on a regular basis on the front page that they're willing to put you on if you can get the inventory and you get a good rep. They have white glove services. They've invested a ton in infrastructure to take sellers that have exhibited knowing how to do e-commerce and supply chain with good products. They want you to come to Walmart. And I think it represents an opportunity that could be as much as 30 to 50% of your Amazon sales next year. That is an opportunity to grow your business 30 to 50% with very little heavy lifting. The other part of that would be live selling and influencer marketing, the rise of TikTok, the rise of, now this is interesting because now you've got the new Amazon program, the Prime program, where they will fulfill everything for you, Prime, on your own website and in different marketplaces. They want you to kind of keep everything at their warehouses, and that makes sense. But this is going to open up the opportunity for you to potentially, again, not disrupt your supply chain, get things into Amazon in bulk, not have to have that overhead of a warehouse, those employees, a new contract with a 3PL, all these things that you have to do. and then just plug in another channel for you that can see a 20 to 50 or even a 200% jump. When you've got influencers in other countries that can do $100 million US in one day, and they still haven't tapped into that in the US, the potential is massive. And I think that we're not very far away. I've said it. I think that first $10 million day is going to happen for an influencer in the US, and it will go public. There will be a story about it. And then the rest of the influencers who have attention and have an audience will pay attention.
Put their rates.
Huh?
They'll put their rates up.
Yeah.
Instantly. Yeah.
All of a sudden, it's going to go from talking about whatever they usually talk about to, by the way, watch me put on makeup and let me make $1 million real quick. Right. Yeah. That's the type of attention you're going to start to get. So I plan on launching at least 3 new brands this year. A couple bigger ones that are going to be expensive, but I think will play well into a down economy. One I'm going to use publicly for content and stuff, so you guys will be able to follow along. But I'm, like I said, I'm looking at this as a huge opportunity to expand and to grow, not just on Amazon, but in other markets as well.
Sounds good. Have you covered? Is that all the points you want to get across before we make
it? I think that it's going to be an interesting 2023 if you're smart and you have good visibility on it, and you're good at keyword ranks and organic. Pay attention to your organic ranks above almost anything else, guys. If you're spending a ton of money, your tacos are high. As long as it's pushing your keyword ranks and you've got that organic traffic, I think you're going to end up landing in a good spot. But make sure that you're converting. Everything's always traffic and conversions. Fix your conversions and then drive the traffic. Make sure that you're pushing those organic ranks, and that at least 50 to 60% of your traffic and your sales are coming from organic. Keep the foot on the gas.
Yeah. Boy Wonder, you're itching. Let's get you on.
I'm itching. So a few things. Some of the things Brandon touched on in terms of diversifying channels. One thing we didn't talk about that I think is will be growing is Buy with Prime. I think that's a game-changing offering by Amazon. We've already seen some of our clients implement it and see much better conversions on their Shopify. We're about to test. I'm not so bullish on this particular source of traffic, but we're about to test basically using Amazon audience data, like competitors and audiences, to use display ads off Amazon into Buy with Prime, into D2C sites. The reason we're testing it is in some cases, Amazon's giving like free money to do it. We have a customer that we got him an offering of $20,000 of free traffic basically from Amazon. We had another customer that got offered dollar for dollar matching up to $40,000. So Amazon really wants to get some use cases and data around this. But I think you'll also see on Amazon sort of promotions of Buy with Prime. You might see a Buy with Prime Day next year. And this past year in Prime Day in the summer, we saw Amazon actually had a page for Buy with Prime for people who ran deals on their websites, and Amazon had that. So I think I think they're going to work on improving the cart and also improving your traffic opportunities into off Amazon with Buy with Prime. And it's a huge opportunity for Amazon, merchant processing, fulfillment, 3% fee, much bigger piece of the entire pie of e-commerce than just what's on Amazon. The other thing I think you're going to see is, we're already seeing it, but continued more data availability for sellers. I think you'll see, lifetime value data, like just more data that Amazon's not sharing now. There's a different philosophy between Bezos and Jesse. And Andy Jesse's philosophy is a little bit, I would say, more open to sharing data, giving that to sellers, not, opening up D2C and collecting a fee on that. So I think you're going to see Amazon giving you more opportunities to connect with customers, like we've seen opening up tailored audiences, more of the UGC stuff. Right now, we've just seen Amazon create this like Inspire thing where influencers can create. If you have the Amazon app as a customer, you might see this light bulb on the bottom. If it's been opened up for you as a customer. But I think you'll see, been saying for a long time, why doesn't Amazon allow brands to kind of do TikTok style reels and stuff, right? Like Amazon Post should allow you to do video. You know, it's like very basic. So I think you're going to see more of these kind of things. The two biggest things I think are going to be like changes. I think what I mentioned before, Amazon Marketing Cloud, I think is a big change. And I think Buy with Prime is going to get more and more traction over the next year.
Cool. Liran, it's holiday time for you already, isn't it? The boys, what's your plans for Christmas? But Liran, thank you for coming on today. Obviously it's holiday times for you. What are you doing for the remainder of the holidays?
Sunday I do like an annual Hanukkah party in my house. So Sunday I'll have like 35 to 40 people in my house, catered kind of event. So that should be fun, family, friends over. So that should be a good time. And you know, for my kids, daughter and my son, they're getting my son not every night because he's 9 months, but my daughter is getting a present every night of the holiday. So that's really, really fun for her. One of the advantages of being Jewish, you know, sometimes there are advantages. This is one of those holidays, you know, you get a lot of presents. So that's really fun. And then have some travel business to Vancouver in January. We're going to be planning out our sort of 2023 with our EOS coach, and also then going on a family vacation to Panama for the first time. So nice. Looking forward to that.
I'll be home with the family, and also it's Maya's birthday as well. So whereas your daughter will get 10 or 12 presents, mine would always complain, where's all my friends? It's Christmas Day. So Christmas Day babies do get a bit of a rough deal. Steve, what's your plans for Christmas?
Keeping it easy. I've got the family at home, and we'll hang out and feast a little bit, and probably watch some silly movies that I enjoy, and yeah, good times.
Excellent. Brandon?
So yeah, just working through it, man. My mom had surgery recently. She's doing a lot better.
That's
thank
good.
God. But she's still in rehab, so visiting her pretty much daily and making sure that she's doing good. And so not able to travel, but have a lot of work to do anyway. So just putting my head down and working through the new year.
Yeah.
Probably do something nice with Jennifer, a nice dinner, and just take one or 2 days off and just
some time with Aiden as well.
Yeah, we've got Aiden for the week, this coming week. So he'll have to take trips from the office to my mom and go visit grandma, and I'll figure out something fun to do with him here and there.
Excellent. Gentlemen, thank you for getting up your time today. Big shout out to the sellers that have had to enjoy this year. Next year will be better time. Try and take some time off. I know you won't, because you'll sit there, whether you're eating Christmas turkey or depending on what you celebrate, it'll all still spin round in your head, and but you need to rest. So try and get some rest over this Christmas period. Don't forget, we'll go again next year. There's much to play for. Take care of yourself. Lots of love, and I'll see you on the other side of Christmas. And thank you again. Bye.
Thank you.
Guys.